Welcome, everyone, to another episode of the None of Our Businesses show and podcast. With me this week, as always, AJ Wheeler.
How's it going?
And Charlie Ziegman.
Hi, everybody.
And we are here on a weekly basis to talk about the news from an accountant's perspective, business news, that is. So let's get into it, guys. Who's got the first article?
Charlie, take it away, buddy.
I've got kind of a lighthearted one. Maybe it's a stretch to say that it's business, but I think we can make it work. So there was an article in USA Today called National Coin Shortage. Pennies, nickels, and dimes and quarters are part of the latest COVID-19 shortage. And so what's happening is that with the partial closure of the economy, the flow of funds that normally passes through the economy has slowed down, says Reserve Chair Jerome Powell. And what's happening is banks are sending less currency back to the Federal Reserve. At the same time, the Federal Reserve is printing less due to measures intended to protect the people working in the mint and whatnot. But the ratios there are not the same. So what's ended up happening is that it's just disrupting the flow of cash through the economy. And so I guess I just want to talk about how soon do you guys think that businesses are going to evolve beyond cash? I know that in a lot of ways that they already have, but there's some, it's not 100%. And so, but it seems like we're moving in that direction. And I guess I want to get you guys' take on when you think if that's something that'll happen in the next, 10 years, 100 years. What do you think?
I don't know. I thought we were kind of already there already. I was kind of even surprised to even hear this come up because I mean, the most I use coins, my dad used to carry around a pocket full of coins, right? So he could make exact change or whatever. But I mean, now I just throw coins into a jar. They're like a nuisance. I would leave them in the, if I go to 7-Eleven or something, I would leave them in the tray, unless they're a quarter or something. But so I was kind of surprised that there's that much demand for coins, outside of an arcade or a laundromat. And the other thing is it costs a lot of money actually to make coins. I'm surprised we haven't moved to a whole dollar system, where everything just goes in dollar increments, because the guy that wrote The Big Short or whatever, the person that predicted the 2008 financial crisis, who was obsessed with Iceland, I guess he was obsessed with nickels. It was his new hustle to make money or whatever, because I guess it costs more money to make a nickel, or the raw materials that the nickel's made out of cost more than 5 cents. So he was hoarding nickels for some reason. But yeah, I'm kind of surprised that coins are even, used anymore or in such high demand.
That's really interesting just about the value of the nickels, because I've read before that that's actually the reason why coins have all the little cuts inside of the edges of the coins, is because people used to shave them down for the materials, and then, and that helps to stop that. And so, but yeah, I think you bring up a really good point. It's like, if we're not even off of dollar, if we're not even off of coins, let alone paper dollars, it seems like we're quite the ways away.
I think it depends on the industries and maybe the locations that people are in, how much they're still using paper money and coins and things like that. Because I think about this and I'm thinking this is one of those things that the coronavirus and the shutdown would, I think, probably have accelerated, along with other things that accelerate during this period of time in terms of adoption and new technologies and people just moving on with things. I think the use of paper money and coins, I would think, would be one of those things that the not using it as much anymore would be one of those things that would have accelerated with the coronavirus. I think about even me in a business context, and even personally, like I don't even want to have to write a physical check and mail it anymore. I don't want to we're already a next generation beyond just cash and coins. I'm to the point of no more checks. I want to do like ACHs and transfers through programs like you can transferring funds through PayPal and Zelle and what's that? Oh, the Cash App from Square, and all the different ways that we can transfer money electronically. I'm always looking to do that rather than just a regular check. So don't even ask me about cash or coins. That's not even a thing for me.
Well, that reminds me, from an accounting perspective, the float is kind of going away. Your float window, I guess, of time of issue of checks and such. If you're going electronic, that window of turnaround between payment issue and payment being received by the counterparty will probably shorten if this happens.
Totally. Yeah, it depends on how you're paying, but yeah, the float is definitely seems to be something that's going to go away.
All right. So our next one I got is actually from Politico, but I saw it a bunch of places. So the IRS thought it wasn't allowed to withhold stimulus checks from the dead, so it paid out more than $1 million in stimulus, or 1 million stimulus checks, I guess. So I guess the IRS flubbed up, or somebody didn't get the memo, so they went ahead and started issuing stimulus checks based on prior year tax returns and current year tax returns. So if somebody is deceased, they have to file that final tax return. And so a lot of people were receiving checks in the mail addressed to the deceased. The IRS found it, stopped it, and asked then that anybody that received the check to please return it if they had issued one to somebody that was deceased. But they didn't come out and say that they had any other plans to do so. So I just thought I'd get your guys' take on kind of this, either the amount of money or the amount of people that received one when they probably shouldn't have.
Well, I mean, I think it's really interesting of a problem, and it's one of those issues of like how to manage this type of program that a lot of people don't think about when they're like, let's pump money into the economy. Sometimes the intricacies of that make that difficult to do. The other thing I was thinking about is just from the standpoint of somebody who had an estate that was due a check, like they're dead, so it seems like it shouldn't go to them. But then at the same time, those funds were paid in over their lifetime and were there for a reason, theoretically. And so I would imagine that maybe somebody who was an heir to an estate of somebody who received these funds might try to argue that they were still due those balances. But yeah, seems like an interesting problem to have.
Yeah, I mean, I certainly didn't receive any rogue stimulus payments myself. So, one take on it could be, well, since other people are getting it and I'm not getting it, they should definitely give it back, right? But the other piece of it, to me, I guess I'm also just too cynical, because for me to care about whether they give it back or not suggests that I believe that the government has a better, more optimal use for those funds, or that the way that they were being dispersed in the first place was an optimal way in which was guaranteed to provide benefit to the economy, and that the incorrect disbursements is misallocating funds in a way that is not going to benefit the economy. And, because from my perspective, again, if I'm looking at it completely selfish, it's kind of the selfish, not selfishness of it is that as a business operator, I want consumers out there to have money so that they'll consume, right? So, do I really care from that perspective? Just cold-hearted calculating and cynicism. Do I really care whether Fred got the stimulus check or George got twice what he was supposed to get? As long as either one of them is going to spend all the money, I guess I don't really care.
Now, was your choice to use Fred a Drop Dead Fred reference, or was that no, maybe not? Okay.
I don't know. Those are the names that always come to my mind. When I was teaching at university, I think AJ took classes with me. He may remember I always used George. So George is always likely to come up. Fred is kind of a secondary.
It's George's friend, Fred,
All right. So I've got another one we can talk about. So there was an article in Accounting Today called Intuit Changes Tech Development Focus and Lays Off 715. And so kind of same theme that we're seeing with a lot of businesses is that they're in a time of restructuring right now due to the virus and everything. And so a lot of them are taking this as a chance to kind of revisit their practices and see what they can do better. And Intuit's approach to this, in the year leading up to this, they had been very focused on artificial intelligence to try to build a better platform for a couple of different accounting purposes, but they're going to change their focus here to be, they're going to lay off a bunch of people, and then they're going to put in developers and salespeople to replace those jobs. But the thing that I found really interesting was that the amount of jobs that they're getting rid of is almost the exact same as the amount of jobs that they're considering adding in the next year or so. And so I guess I wanted to get your guys' take on whether or not you feel that companies who do this kind of thing are really trying to change their focus, or whether or not they're using the pandemic as an opportunity to do a restructuring that they maybe wanted to do anyway and just feel that it's an easy time to do it.
Well, I want to maybe see if you guys picked up on it more, because I understood their prior focus on AI, and I understood them saying they were cutting back on it. But what they were saying they were shifting their focus to, I had a hard time putting my thumb on it. I wasn't sure I really understood. I mean, I kind of got that they're shifting their focus to something that would be more meaningful during the pandemic, but what exactly that means, or what it was, like virtual something or other was what they said. And I didn't get it.
It was online platforms, and the way that I took it, though I agree with you, I had to kind of read into it, but I took it to mean that they were trying to build integrations with sites built around e-commerce because they felt that those things, that was the direction things were changing. And so I kind of am taking their term online platform and extrapolating it to maybe what I think it means.
That totally makes sense, though. That makes sense. I'm going to pretend that you wrote it and that we know that's what it means, because that makes sense. So I mean, yeah, they need to, people are buying more stuff online, people are using e-commerce more, so Intuit saying, holy shit, we need to make sure that we're integrated with all that stuff. We're not as integrated as we should have been. Cut our AI budget and get our developers over there and get them focused on that would make some sense if that's what they're doing.
And I like the practical move of it. I mean, I think it makes sense to have AI as this goal and this maybe long-term plan that we're working towards. But whenever there is maybe, this kind of thing happening, it makes more sense to reevaluate and look at something that has more impact in the short term. And I think that's what they feel this will lead to.
Well, and on that point, I kind of wondered if this was a sign that perhaps this AI revolution that we're all talking about and waiting for actually isn't happening as quickly as we think it is. And that maybe part of this was Intuit recognizing, hey, you know what we're trying to do? We actually can't do it. The technology is not available yet. So let's do something, like you said, more practical that would affect us today, because we can't solve some of these AI problems in real time anyway.
So actually, I think that's a smart move by QuickBooks if that's actually what they're doing, because if you can offer like some of those enterprise type suite, like I'm thinking of like a Bill.com, if you can offer a Bill.com at a really reasonable rate to small businesses, integrated into your package, or a Shopify experience that seamlessly integrates with your accounting, you might not, it brings the human element, I guess that was what Ty was talking about, but it makes it much easier to sell those products, I think, at a lower price, and it's available to everybody, and it's kind of within the ecosystem. And I think they already have that ecosystem there a bit. So I'm wondering how it'll affect the desktop product, and if that will be around anymore.
Yeah, it definitely seems like they're moving away from that direction. The other thing I was just thinking about is that they're not mutually exclusive. So it's like if they go ahead and do all this development to integrate with all these other platforms, and then they decide to focus on AI in the year after that, it really doesn't, damage them to have integrated with all of these things beforehand. And it's not as though once the AI thing is figured out that all of these other platforms just wouldn't exist anymore. So, yeah, I think it makes sense.
All right. So actually, this one has got a lot of people in the accounting world talking. I was actually on Twitter early this morning, and I saw some people kind of going back and forth about that. I'll get into it after I explain. So Muchin says he's considering a second tax due date extension. And so it says it's something he's thinking about, extending from July 15th further forward. And actually, it's got a lot of people in the accounting world talking, because as they've been saying, they've been ramping up to PPP loan questions and work a lot. And now that they're going to kick the can down the road, that means that they're going to have to file now extensions for all their clients. And the AICPA is firmly against this. They've taken a stance that they do not want the deadline moved. And according to a Twitter user, has gone so far as to contact a partner for an accountant that posted something on Twitter that was, basically saying they should move the due date. So anyway, I'd like your guys' take on it. See what you guys.
Yeah, I think. I'm glad you brought up the AICPA point, because that was the thing that I saw when I read that article. Was like, I think the article cited a couple of taxpayer organizations that was lobbying in favor for having the deadline moved, and the AICPA, the organization for CPAs nationally, is totally against it. And I mean, I think it's interesting from an accountant's point of view. I guess there's things I know that we all know about accountants, about our brothers and sisters in the accounting profession, and that we may that we may kind of understate. And I think this kind of highlights that to some extent in the sense that en masse, on average, if we're painting with a big wide brush, which is always a little dangerous to do, but en masse, as accountants, we aren't necessarily self-starters. We like having a deadline to work toward, and I think it's made our profession very uncomfortable that deadline has moved. And I think a lot of people said, well, the deadline moved, and so that just extended our tax season when it moved to July 15th. And in one breath, part of the blame on that was and part of the reason for that was because we did more work with PPP than we did with traditional tax work, which makes sense. But then you think about it as like, well, if the deadline hadn't moved, then you'd really be screwed, right? But I think part of what I think a lot of them are actually saying secretly too is, and we didn't work as hard as we normally would have before April 15th. And so now we've got we have a back pile of work to do before July 15th. And when they say we, it's often, I'm talking to leaders of firms. And so part of what they're actually saying is it was hard for them to really motivate their team and their staff to get all the chargeable hours in before April 15th. And, given that everyone was having to work on PPP as well, and we had entered this global pandemic with people and everyone was being forced to work at home, and a lot of people weren't used to working at home and having to work through those dynamics. And so people just lost the chargeable hours going into April 15th. So all of that led to, our busy season's extended to July 15th. And when we as accountants would normally be able to kind of take a breath and relax in May and June, we weren't able to do that. And so I think I sense that feeds into the AICPA's position of we shouldn't extend the deadline further. I suspect, and I haven't followed it the way you have on Twitter or otherwise, I suspect the AICPA would push back on me and say, well, this isn't just about us, it's about our clients, that without the deadline, our clients won't get the information in, and it kind of doesn't discipline the small business. It doesn't discipline the businesses to get this done sooner, and makes it harder for everyone altogether in a variety of ways. And there's probably a lot of truth to that. But here's the other problem with the whole thing is how this is going is it is now, as we're doing this, it is now June 26th. The deadline is a couple weeks away from here, and Mnuchin's saying he's thinking about extending the deadline. And the way most of these things have gone this year, if he does extend the deadline, or if they do extend the deadline, what do you bet that it's going to be like 2 or 3 days before the deadline, when most accountants have probably done what they had to do to get these returns filed, and clients have already everyone's done what they need to do. So on the AICPA side of the position, I think where I'd weigh in kind of in favor of their side of the position is I'd point out, if they really wait that long to extend the deadline to the last minute, the only ones they're benefiting are the super last minute folks on everything, right? And that's, that's in regard to the filing deadline. I think the nuance here, I was talking to a client about this the other day as they were talking about the potential for the deadline delay. And I said, well, keep in mind that there's two things to talk about here. And really what the taxpayer wants is a delay in paying, right? So there's a difference, from a tax law standpoint, there's actually a difference in how we regulate filing deadlines and how we regulate payment deadlines. So I think the accountants are all concerned about the filing deadline, and the taxpayers are all concerned about the payment deadline. So I think there probably could be a compromise here between the different organizations, right? Let's say we have to file by July 15th, but we get to extend when we pay. Everyone wins, right? Sounds good to me.
Sounds good.
Mushin's going to hear this and just take credit for it and be like, yeah, that's what I meant. Payment deadline moved, not filing deadline.
Just for those accountants. We'll keep the filing deadline so those accountants can have a good last half of the July before they get into the extension filing season of August, September, October.
Yeah.
The only theme I'm seeing develop here is that all of the people who would actually have to kind of deal with this are the ones who are, not for it. So I think the AICPA is predictably reacting to, and, something that's going to influence them. Whereas the taxpayers, they're just looking to extend that as far as they can get it,
It's true. So the new the new PPP loan rules for owner employees of S and C corps are bad news. This is out of Forbes, and Alan Gassman is the writer. So I thought it was a really good article. He talks about the easy applications and instructions related, enacted and published since June 5th. And so he kind of breaks down in great detail. I encourage anybody to read it because I think he does a really good job of breaking down the different numbers, and he has examples. So, but he has bullet points here of what's making it kind of bad news. So group health insurance costs of an individual who is an owner of an S Corp cannot be included in a forgiveness amount. So this one makes sense because health insurance premiums paid for S Corp shareholders who own more than 2% of the company are deductible but reported as compensation on a W-2. Thus, the amount of the health insurance costs are already included in his or her income. So the next one, he said, compensation counted for owner employees cannot exceed the pro rata portion of what they were paid in 2019. So I had to read through the example he had to kind of really understand that one, but it makes sense once you read through it. And then the last one is the $28,000 for 8-week testing, or 20,833 for 8-week testing versus 46,154 for a 20-week testing. So I guess this is based upon the premise that forgiveness for a company should not exceed the amount that was loaned for wages of its owners. And then what about retirement plan expenses? So the PPP loan was very generous on the lending side, including equal to 2.5 times the annual expense for retirement, considering that many small companies, the vast majority of contributions are for highly paid employees and owners. So he kind of goes through then. It's unknown whether it was intended this limitation would apply for borrowers. And then his last one is, what is an owner employee and what can be done to avoid this limitation? So he says that the rule prevents no hint as to what owner employee is, but we can assume that this is a person who has an ownership interest of the borrower and will not include the spouse or family member. So I would kind of like get your guys' take on some of this.
Well, I think kind of at walking through some of those technical items that you did, I mean, if you were to sum them up, what's the spirit of what they're doing here is, it seems like the spirit of what they're doing is they're saying, look, you can't achieve the level of expenses necessary to reach forgiveness by just paying your owner employees more money, right? That's what these rules revolve around, right? Is that the money wasn't designed to just up the wages of owner employees of small businesses. It was designed to protect the paychecks of the rank and file employees as well. And so it seems like these rules are maybe targeting that exact issue to say, well, you can't not pay employees and pay yourself more and then claim that you have the same wage base necessary to get forgiveness. I think that's what these rules essentially prevent, and seems reasonable and sensible to me.
Yeah, it definitely seems reasonable because even with the rules in place, I've seen so much pushback on articles saying that this is like the largest transfer of wealth in the history of the country and all these sorts of things. And I think that if the owners are able to just take the loan and then give it all to themselves, it not only defeats the purpose of that, but just increases that problem of wealth transfer. And so I think that, yeah, it seems not in the spirit of the loan itself.
You got another one for us, Charlie?
Yeah, I got another one we can do. So there was an article in Wall Street Journal called "A Bargain with the Devil. Bill Comes Due for Overextended Airbnb Hosts." And I thought this would be a good one to talk about. Basically what it's looking at is it did an interview with a person named Cheryl, who was an Airbnb host with a large portfolio. And she had gotten into the habit of just every time her phone would ring saying that an Airbnb rental had taken place, she would just think about that as free money. And so she got used to this idea of just like having this stable, income off of Airbnb. And then as soon as the coronavirus hit, that income stream definitely changed a lot. And in the example or in the interview, she wasn't prepared with enough liquidity to withstand the changes that happened in her revenue stream. And so she viewed it as that she had signed a deal with the devil, based around future revenues. And so I think it's happening to a lot of people right now. I think it's a good thing to talk about, but at the same time, I think it's like, people have to have that people have to look at leverage as a risk and essentially make decisions on what they can handle based on what they have available to them. And I think that's something that people are not very good at doing. And it's really easy to like set up these promises with yourself of like, oh, this rental is going to churn this much money every month, so I'm going to do all these lifestyle changes based on that. And then if it doesn't play out, it just doesn't work out. And so at the same time, leverage oftentimes works to the advantage of the person borrowing. So I guess I wanted to get your guys' take on how you, in a practical way, kind of evaluate when it makes sense to take on that kind of leverage.
Well, yeah, and I think the article kind of harkens to, and you harken to the point that a lot of these small, like individuals running a business or a family running a business like an Airbnb or something like that, or a small bed and breakfast or something, might swing at this because they heard it was going to be forgiven, and then realized, and banking on the fact that things were going to open up in a couple months, and then have it come due is a different thing where they're not able to pay it. So I think with time comes wisdom. It's the same reason why all those business proposals go from 200,000 in sales to 200 million and over the course of 2 or 3 years. I think with the time comes wisdom and experience that probably isn't the case. And I think this is probably a learning experience for those businesses that on leverage, a hard one to learn, but I think it's one that will be brought out because of it.
Well, I mean, and I think it was very interesting to me because this is definitely that the kind of business those Airbnb operators are running was something I personally been very interested in and wanted to consider doing. I happen to live in an area though where we are in Portland, where the city discourages it through permitting processes and other things that really limit your ability to do it, at least if you want to do it close in and locally, and which is kind of how I looked at wanting to do it. And so I kind of got saved from myself by local regulation that just wouldn't allow me to do what they were describing was being done in those articles. I mean, the thing is that, yeah, it's not, it actually, they mentioned that the Airbnb platform kind of made some small entrepreneurs into kind of amateur hoteliers, right? And I think that's right. I mean, if you were in the hotel business, you're also hurting, and you probably have loans related to your real property assets and things like that. So it is actually the same dynamic. The difference is probably that the average business, the average company that owns hotel type assets, those kind of assets, maybe has a little bit more sophistication in managing cash flow than the average small business or entrepreneur who's kind of doing these Airbnb schemes. But that's just kind of a guess in terms of the different populations. But overall, it's the same problem. So yeah, I think you guys hit it right on, that it's really just a matter of how much leverage do you take when your revenue is maybe not consistent and can't always be counted on because it depends on externalities. That's true with every business though, right? I mean, we all need customers. Every business, we all face the problem that we can't totally control our entire outcome. It is dependent on the availability and ability of customers, right? But in this particular, I think what we're seeing in this newer economy before COVID is that you've got this additional layer where small businesses are often dependent upon platforms, whether it's Airbnb or Amazon.
And actually, the article talked about that a little bit, about how Airbnb as a platform is struggling as well. So they've kind of got that going. The other thing that I thought was interesting is the article only touched on it a little bit, but I thought one of the, at the end of the day, this whole discussion is kind of about how do you manage risk? And we're looking at it from the scope of financial leverage when in the context of debt. But the article touched on how some Airbnb owners also try to address this problem with their policies as well. So maybe they have the same amount of debt, but they set it up so that cancellations only result in a 50% refund instead of a 100% refund. And that helps them to be a little less exposed when there is turbulence in the revenue stream. And so I thought it was interesting to try to think of kind of creative policy type things that you can do that do lower your overall risk, but don't really change your financial leverage, so to speak, because they still have the same amount of debt in the example. But yeah.
Can you imagine though? I mean, I think we probably talked about this on other articles, or in other episodes, but like, yeah, I can't imagine if I own an Airbnb and the pandemic is breaking out and people are being told to stay at home, they can't travel. And I tell a customer who's paid for their Airbnb or whatever, made their deposit, you're not getting it back because I need the money, even though they're not going to use I mean, that's rough, right? It's, I guess,
Sound awful. I will
yeah.
give you that. It sound awful.
All right. So our last article, this one's small businesses expect to fail. Here's what will happen to their PPP loans. So this is talking about, there was actually a roundtable recently with the SBA, and millions of small businesses have gotten federal aid either through the EIDL, which is the Economic Injury Disaster Loan, or the Paycheck Protection Program loan. And so here, I guess they were asking, are owners and operators going to be on the hook for these if the business ceases to exist? So loan defaults, the business doesn't shutter necessarily, but they default on their loan. And so what they're saying is all loans, PPPs didn't require a personal guarantee, and EDL loans didn't require a personal guarantee or collateral up to $25,000. But the EIDL loan that exceeds $25,000 are collateralized by any assets the business has. So inventory, receivables, any equipment, or any tangible assets that can be seized to take the entrepreneur's debt if they're default on the loan. But in addition, disaster loans exceeding $200,000 required a personal guarantee. So that means that the lender can go after the owner's business personal's assets, cars, bank accounts, all of that, if they end up there. Bankruptcy now, businesses that want to avoid a loan default can instead seek bankruptcy protection. And so if you're filing for Chapter 11, they can generally be discharged in bankruptcy, said a director of the leader of North American Financial Services, said they could be generally discharged. But there's a big debate, I guess, around around the bankruptcy. The initial application process is vague at best for as far as like the economic need and the personal guarantee required around it. So they're thinking there might be legal legs there to keep it. I would just like to get your guys' impression on, the vagueness of the rules come into play again, I guess.
Well, I mean, I think what we're going to find is what we've been finding with the PPP loans all along, which is that everything changes all the time. And I think until we get to the point where these bankruptcies we're talking about are happening en masse, then we can't say with any certainty what the reaction will be, because I think any technical answer just falls flat as soon as stuff hits the fan, so to speak.
Yeah, 100%. I second what Charlie just said, is that these things are very political. And so, if a few people are going through bankruptcy, then they probably aren't going to get much leniency. But if there's, if it's affecting the business community in a major way and Congress is, hearing about it, and yeah, anything's up for grabs in terms of the rules and how this might work in the future. So I think that's exactly right. It's what happens to the majority of PPP loans will then dictate kind of the pressure that gets put on politicians, and then the politics will come into play, and then we'll see what happens then.
I will say, just as I think about it, that if I imagine an example of a business owner who took the PPP loans, used it to keep his employees employed, went out of business eventually, and then gets his car taken as a result of those series of decisions, that doesn't seem right to me. And so I think from that angle, it seems like it should be, there should be a layer of distinction there. But I guess it depends on the usage of the PPP loans, really, because in the example, it all went to employees, which was the purpose of the loan. So, if somebody takes the loan and then just draws it all, then them losing their car as a result of that decision isn't sad to me. So,
right. Yeah, and to clarify on that, I think that when AJ was kind of citing some of the details, it's the EIDL loans where there may be personal guarantees if it's over a threshold. I don't think there were personal guarantees involved in any of the PPP loans. But when you talk about the scenario that you said, even without a personal guarantee, if somebody misused the funds, they shouldn't believe they're going to get away scot-free. There's definitely a possibility if they got their PPP loan in a company and then drew it all out for themselves and the company went out of business, that the government might have some recourse on that.
True. And it's an election year, like you said, like this is a very political issue. And I think, yeah, anything's up for grabs at this point.
All right, everybody. Thank you for watching the None of Our Businesses podcast. Tune in again next week for more of what's going on in the world of business. Please like and subscribe. Thank you.
See you, everybody.
See ya.